In any market, there's always one investment that captures everyone's attention, the new hot thing that seems to have it all. And right now, that's FDVV, the Fidelity High Dividend ETF. It's the talk of the town. But today, we're going to peel back the layers and get to what's really going on with this fund. Because really, that's the single most powerful question you can ask when something new and exciting pops up. Compared to what? It just forces you to step back from all the marketing, all the noise, and really think about what you're buying into. In this quote, it just absolutely nails the theme for our whole analysis. Is FDVV genuinely something new and improved? A better way to invest? Or is it just the same old risks we've always seen, just, packaged in a shiny new wrapper? Let's find out. Okay, first things first. We gotta get why dividend investing is so powerful to begin with. The appeal is almost primal for investors who are looking for some stability and real income. Man, I love this line because it's so on the money. Think about it. A company can't fake a dividend payment for very long. It has to come from real, cold, hard cash. It's a signal that the management team is disciplined enough to not just make profits, but to actually return some of them to you, the shareholder. But here's the catch, and this is super important. Chasing the highest yield you can find can be a total trap. A company might have a massive yield just because its stock price has completely tanked. That's not a sign of income. It's a huge warning sign. And it's this exact balancing act between that juicy yield and potential high risk that FDVV is trying to pull off. All right, so let's look at the story behind FDVV, the one that's got so many investors excited. And you know what? On the surface, the numbers look pretty darn compelling. Boom, 3.7%. I mean, in a world where it's tough to find yield anywhere, that number just jumps right off the page at you. It's an immediate, tangible return that's really hard to ignore. And this chart just puts it all into perspective, doesn't it? You can see it right there. FDVV is offering more than double the income of the broader S&P 500. If your main goal is to generate cash flow from your portfolio, well, this is a very powerful argument. Now, what's really interesting here is what's inside that nearly 40%. We're talking about the big dogs, household names in energy, healthcare, finance. These are blue chip companies, which gives the fund this feeling of quality, of safety. So you're getting a high yield and familiar, stable businesses. Sounds perfect, right? Well, this is where we need to stop looking at the shiny surface and really dig a little deeper. Let's get into how this fund is actually built, because it starts to paint a very different picture. So when you lift the hood and look at what's inside, you see the fund is making some pretty massive bets. It is heavily concentrated in cyclical sectors like energy and financials. Now look, that's worked out great recently, but what it really means is that the fund is structurally fragile. It's basically built to win in one very specific economic environment, one with high energy prices and rising interest rates. And that's fantastic, right up until that environment changes. And this brings us to a really fundamental divide in investing philosophy. Are you a dividend chaser, focused on getting the highest yield you can possibly get today? Or are you a dividend growth investor, focused on companies that consistently, year after year, increase their payouts over time? See, the first one's a tactic. The second one, that's a long-term strategy for compounding your wealth. And this right here might be the single most important detail for any long-term investor. FDVB's method looks for high yield, and it looks for some quality metrics, but it does not require a history of dividend growth. That shiny 3.7% yield, it's just a snapshot in time. It tells you absolutely nothing about the company's ability or its commitment to keep paying you and hopefully paying you more 10 years from now. This whole conversation isn't really just about FDV. It's about some timeless core principles of investing that, let's be honest, we all sometimes forget when something new and shiny comes along. So when most of the financial world talks about risk, this is what they mean: volatility, the day-to-day ups and downs of the market. But the problem with thinking that way is that it forces you to react to every little price swing, often panicking at the worst possible time. Here's a much better, smarter way to think about risk: the permanent loss of your money. The real danger isn't that FDVV's price might drop 15% next month. No. The real danger is that its underlying strategy causes it to underperform for a decade while you're holding it. And that's a loss of time and purchasing power you can never, ever get back. People often see that an ETF holds over 100 stocks, and they think, oh, I'm safe, I'm diversified. But that's just the illusion of diversification. As this quote just hits the nail on the head, if all those companies are vulnerable to the exact same economic shocks, you're not diversified at all. You just have what you might call correlated comfort. Okay, so here's the real test, the ultimate gut check. If the market absolutely craters tomorrow, I'm talking down 40%, would your belief in FDVV's strategy be strong enough to hold on, or would you sell? If the honest answer is you'd probably sell, then it's not a core strategy for you. It's just a short-term fling. So this brings us to what really matters, the choice you have to make. And look, it's not about labeling FDV as good or bad. It's about understanding what tool you're using and what job you're trying to get done with it. So let's put FDVV in context with a couple of its well-known peers. You've got VIG, which is laser-focused on a long history of dividend growth, so it has a lower yield. Then you've got SCHD, which does a beautiful job of balancing both yield and growth history. And then there's FDVV, which clearly prioritizes a high current yield above pretty much everything else. There's no single right answer here, only the one that actually aligns with your own goals and your own temperament. So, what are the big takeaways from all this? First, and this is huge, a high yield is a symptom. It's not a strategy in and of itself. Second, true quality is only revealed over long stretches of time, not in a single snapshot. Third, remember that our own emotions often end up costing us way more than any fund's expense ratio. And finally, the best investors invert. They always ask what could go wrong here before they start dreaming about what could go right. And I want to leave you with this final thought. So, is FDVV a star or a risky bet? In the end, the answer has less to do with the fund itself and everything to do with the investor holding it. Chasing the hot new thing is a recipe for disappointment. But understanding your own strategy, your own time frame, and having the discipline to stick with it, well, that, unlike yield, is something that compounds forever.